The number you see on the news as the price of oil is not the price of oil. It is the price of a futures contract on a standardized barrel of North Sea crude, expiring next month, traded by people who will never see it, touch it, or take delivery of it. Under normal conditions, that number is a reliable proxy for what oil actually costs. Right now, it is not. Two completely separate oil markets have been pricing two completely different worlds simultaneously, and the gap between them hit $65 per barrel. Let me give you the numbers first. March 23rd, 2026. The Dubai Crude benchmark, the price that determines what Asian refineries actually pay for Middle Eastern oil, reached $169.75 per barrel. On the same day, Brent futures, the number on your newsfeed, the number most people think is the oil price, was trading near $104. A $66 gap. Same day, same global oil market. And beyond that flat price gap, the internal structure of the Dubai futures curve told an even more extreme story. The spread between the prompt month contract and the 2-month forward contract reportedly reached $55 to $65 per barrel. In a normal market, that spread is $1 to $3. The physical oil market was not just expensive, it was screaming. This chart shows the DME Oman front month price from February through to today, $70 before the crisis. The Strait of Hormuz closes on February 28th, and the price does something that had no modern precedent. 80, 100, 140, 145 on March 23rd. The full Dubai benchmark, tracked by Commodity Intelligence Services, hit 169 on the same day. Then a sharp correction as ceasefire rumors entered the market. Today, the price sits near $100, still $30 above pre-crisis levels. Still pricing a world where physical supply has not normalized. Before we go further, we need to be precise about what these two numbers actually measure, because the gap only makes sense once you understand this. There is no single oil price. There are three regional benchmark systems. ICE Brent, the most quoted price in the world, is priced off physical North Sea crude. 5 grades, 600 to 700,000 barrels per day of production. Assessed by S&P Global every afternoon at 4 o'clock London time. That assessment anchors the number on your screen. Here is the critical point. In normal markets, the price formation chain runs from physical to paper, not the other way around. Cargo traders trade real North Sea barrels. S&P Global observes those trades and publishes the dated Brent assessment. Brent futures price themselves as a forward expectation of where that assessment will be at expiry. The two stay linked through arbitrage. If futures diverge from physical, traders close the gap immediately because it is profitable to do so. That mechanism has one requirement: physical delivery must be possible. When it is not, the gap between paper and physical has no ceiling. The Asian crude benchmark works the same way, but the physical grades it relies on are different. Dubai is priced off a basket of 5 physical crude grades: Oman Blend, Upper Zakum, Al Shaheen, Murban, and Dubai itself. 2 of those 5 load inside the Strait of Hormuz, 2 load outside it. When Hormuz closed, Upper Zakum and Al Shaheen, the 2 Hormuz-exposed grades, effectively disappeared from the basket. Their combined share fell from 62% of basket flows in January to approximately 14% by April. The benchmark that prices every barrel of Saudi, Iraqi, and Kuwaiti crude sold into Asia was now being assessed on a fraction of its normal physical basis. The price it produced was not wrong. It was pricing real scarcity, but it was pricing it on a thin, compromised basket. The closest public data proxy for the Dubai benchmark is DME Oman, one of the 5 basket grades, loading outside Hormuz. This chart tells the story using only public data. DME Oman surged to $145 on March 23rd. Brent peaked later at $127. The gap in public data, $35 to $40. The gap in the full Dubai benchmark, where basket liquidity had collapsed, was larger still, Under normal conditions, Brent trades at a modest premium to Dubai, roughly $1 to $4, reflecting Brent's lighter, sweeter quality. Better quality crude commands a better price. What happened in March inverted that relationship entirely. Dubai was trading $60 above Brent, not below it. The two benchmarks were not just far apart, they were on the wrong side of each other. A second signal tells the same story from a different angle. Vessel tracking services widely reported crude piling up in tankers anchored in the Gulf, unable to transit Hormuz. This is what the industry calls floating storage. Crude that has been loaded, that has a buyer, but simply cannot move. Before the crisis, around 9 million barrels were sitting in floating storage in the Gulf. By late April, it was approximately 105 million barrels, a 12 times increase in 8 weeks. That crude existed. It had buyers. It simply could not move. The physical supply crisis was not theoretical. It was sitting in anchored tankers, visible on satellite with nowhere to go. Now, the concept that ties all of this together, the futures curve. When you buy a futures contract, you are buying oil for delivery at a specific future date. M1 is next month. M3 is 3 months out. M6 is 6 months out. The relationship between those prices tells you something precise about what the market thinks is happening to supply. When M1 trades above M2, above M3, that is called backwardation. The front month is more expensive than later months. The market is saying, supply is tight right now, but will ease. Physical buyers are paying a premium because they cannot wait. In a genuine supply disruption, backwardation is the expected signal. The steeper the backwardation, the more acute the physical scarcity. The opposite is Contango. M1 trades below, M2 below M3. Supply is ample now, or the market believes it will be. Storage economics work. You can buy physical today, store it, sell it forward, and lock in a profit. In a normal oil market, the M1 to M3 spread is roughly $1 to $3 per barrel. The Dubai M1 to M3 spread reportedly reached $55 to $65 at the crisis peak. That is not a price signal. That is the physical market telling you it needed oil immediately, not in 8 weeks. So why didn't Brent reflect this? Because Brent prices a different world. ICE Brent is anchored to the North Sea and the Atlantic Basin. When Hormuz closed, Middle Eastern crude could not reach Asian refineries. But the crude that would normally supplement Middle Eastern supply into Asia, West African barrels, North Sea barrels, couldn't be rerouted east quickly enough either. The voyage from the US Gulf or West Africa to Asian refineries, either through a risk-elevated Suez Canal or around the Cape of Good Hope, takes weeks longer than the Middle East to Asia short haul. Asian refiners cut run rates because they needed oil now, not in 6 weeks. Meanwhile, Atlantic supply accumulated in the Atlantic Basin. Brent, priced off that world, stayed relatively contained. The $66 gap was not a market error. It was an accurate simultaneous measurement of two completely different supply realities. So how do you know when the oil price can be trusted again? Here is a simple 4-question framework. These 4 questions tell you whether the futures price is a reliable proxy for physical market conditions or whether you are trading noise. Question 1. Is the benchmark basket liquid? For Dubai, are all 5 physical grades trading in the assessment window? If key grades have gone dark, the benchmark is compromised. Currently, not fully. Quality bias is present. Question 2. Does the curve structure match the physical balance? Is the degree of backwardation consistent with the known supply deficit? Currently, partially. Curves at around $8, M1 to M3, with a real supply deficit still running. Question 3. What is freight doing? Freight rates reflect the actual cost of moving crude. They cannot be moved by a headline. Currently, rates elevated at WS 165 to 200. Cancellation rate around 60 to 70%. Physical stress still real. Question 4. Is floating storage rising or falling? Rising means physical stress is building. Falling means resolution mechanisms are working. Currently, just beginning to decline from the 105 million barrel peak. Not yet a confirmed trend. 3 of 4 flags are still amber to red. The market has priced the probability of reopening. It has not yet priced the slow restart that follows. 3 things to watch this week. Signal 1. Peace deal progress or escalation. Any credible ceasefire signal could remove $10 to $15 from Brent overnight. Any escalation, particularly a US naval operation to clear Gulf vessels, would spike the front month sharply. But ignore the diplomatic headlines. Watch the physical confirmation. Hormuz-laden crude crossings are running at 1 to 2 per day against a pre-crisis norm of 30 to 40. A sustained move above 10 per day is the ground truth signal. Signal 2. Gulf floating storage, 3-week trend. Storage has barely moved from its peak. A sustained 3-week decline is the first physical confirmation that crude is beginning to move. Signal 3. Brent and Oman reconvergence speed. As of May 6th, Brent at 102 and Oman at 101 are nearly back in line. If reopening occurs, watch whether Oman compresses faster than Brent, meaning physical led, more durable, or both move together, meaning sentiment-led, more likely to reverse. That speed differential is the most information-rich signal in the post-reopening window. The paper market has priced the door opening. It has not priced what is behind the door. The restart is a slow ramp, not a switch. You can find the full analysis in issue 3 of the Crude Oil Desk newsletter at crudeoildesk.com. Subscribe and hit the bell so you don't miss our next video. We'll see you next week.